Hello, and welcome to Donation Investment. This analysis is for Arch Capital Group on Nasdaq as of 16th of July, 2026, with a share price of $100. The full report is on donation.ca. Arch Capital is an elite specialty insurer trading at an attractive 1.7 times tangible book, and the medium and long calls are both buy, but the short-term call is hold. The tape offers no discounted entry, and a Q2 print lands on 28 July, so the near-term stance is buy on confirmation, accumulate on weakness. The quality here is genuine. Arch runs a combined ratio in the low 80s, well under the 100% underwriting profit line, and earns returns on equity in the high teens. Book value per share keeps compounding even as buybacks shrink the share count. On valuation, the shares trade at roughly 1.7 times tangible book against a warranted multiple near 3 times, a ratio of 0.57 that sits firmly in the attractive band. Even on a conservative growth assumption, the stock still looks cheap for the quality. So why not buy today? The near-term tape gives no discounted entry. The price sits about 14% above weekly support. Daily volume is running below the level needed to confirm a breakout, and there is no fresh trigger. On top of that, a Q2 print lands on 28 July, the one binary event for this name. The fundamental case is already met. The stock is cheap, but with no technical or catalyst confirmation, the timing score is only 55, and the short horizon is capped to hold, buy on confirmation. The underlying drivers are balanced. Higher for longer rates let Arch reinvest its float at attractive yields, a genuine tailwind for investment income. But property catastrophe and P&C pricing are softening off the hard market peak, and mortgage earnings are near cycle highs. The driver score of 60 sits in the neutral band, which means it is not eligible to amplify the signal. The report is honest about this. It does not manufacture a stronger buy. Quality carries the longer horizon case, not a cyclical push. The risks here are cyclical, not solvency. The bear case sees the stock fall to about $80, roughly 20% below today. That would take an adverse reserve development quarter reversing the Q1 release, softer P&C rates lifting the combined ratio back toward the mid-90s, a heavy catastrophe season, and a housing downturn denting the mortgage arm. And the 28 July print is a live binary near-term event. This is a real risk, not a distant tail. Now weigh the risk against the reward. The bull case is roughly 22% above today, the base case, the most likely, about 10%, and the bear case a fall of about 20%, so you are risking about 20 to make 22. So, our call on Arch Capital Group on Nasdaq, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donation Investment at donation.ca. The link to the full report is in the notes below. Have a great day.